We discuss what will happen to the U.S. economy in 2024 in today's video. Since the expert opinions are all over the place, please share your predictions with me in the comments section below, whether you envision a recession or a gentle landing. Naturally, the Federal Reserve is where the story starts. The minutes of their most recent FOMC meeting were just made public. The unfortunate reality is that we are powerless over them. You and I will suffer the financial consequences of their decisions, good or bad. As a result, they are navigating the ship, and maybe this won't end up like the Titanic. The Fed is clearly sending out the word that they are done raising interest rates, as seen by the suggestions made in the minutes. In my opinion, interest rate increases for this economic cycle are complete. This implies that interest rate reductions will happen shortly. Almost all participants in the Fed minutes agreed that a rate reduction in 2024 would be reasonable. According to the minutes, 3 interest rate reductions are expected this year. They did not, however, provide an estimated start date for the cuts. Will it start in March then? Will it commence in September or at a later date? As of right moment, no one is certain. The problem is that when interest rates are lowered, an easier monetary environment is created, which raises demand and raises inflation. Thus, the Federal Reserve recognizes this straightforward idea. They also do not wish to witness a stock market fall. Neither do they want to watch the stock market soar and have it fuel inflation. They are acting as puppet masters because they desire predictability and smoothness, and housing values will follow suit. Reduced interest rates will spur demand, which will lead to inflation. Additionally, it will have an impact on rental costs, and the Federal Reserve does not want to see a resurgence of shelter inflation. The Federal Reserve's ultimate goal is for 2024 to be a trouble-free year. They also don't want to see anything crash, nor do they want to see prices soar. In order to achieve a lovely, smooth landing, they are attempting to reduce volatility. They want it to happen, but is that really what they want? I wish to share with you the predictions made by the major institutions. We'll start with the recession projections from 9 reputable institutes listed alphabetically. Wealth Management at Bank of New York Mellon. We anticipate a healthy downturn in 2024. As half of the world's population casts ballots to choose leaders and problems, we also anticipate some turbulence. Thus, rather than a recession, they anticipate a slowdown. Charles Schwab says cumulative rate hikes may begin to weigh on growth in coming quarters, observed in climbing bankruptcies. Schwab discusses the negative effects of rising interest rates as well as the delayed impact. Citi Global Wealth reports that we see a deceleration in economic activity during the early part of 2024, followed by an economic acceleration later in the year. Citi therefore anticipates a worsening situation before an improvement. Fidelity, unless something extraordinary happens, our base case for 2024 is a cyclical recession. We anticipate that the economy will eventually contract. Goldman Sachs, we continue to see a 15% chance of a U.S. recession. We anticipate robust rise in household income, a rebound in manufacturing, and a greater readiness on the part of central banks to implement rate cuts in the event that growth slows. J. Morgan Chase, in 2024, we expect both inflation and the economy to soften. State Street reports that investors are underestimating the risks to the economy, also the potential for increased market volatility in a contentious U.S. presidential election year. UBS said, "We expect the U.S. economy to experience slower growth in 2024 as consumers face mounting headwinds. They anticipate slower growth, but do not anticipate a recession." The Vanguard Group, we anticipate that the U.S. will grapple with mild recessions in coming quarters and that central banks will cut interest rates in the second half of 2024. Regarding rate reductions, this is what the market anticipates. The next meeting of the Federal Reserve ends on January 31. The market does not anticipate a rate reduction from the Federal Reserve at that meeting. The CME Fed Watch tool provides evidence of this, indicating a 93% likelihood that the Federal Reserve will not lower interest rates in January. The following meeting is scheduled for March 23. The market is getting excited about this encounter. By then, there is a 66% probability, according to the market, that interest rate decreases will begin. But bear in mind that when examining three matches, these odds may start to seem off. I now want to share with you the statements made by the major banks regarding interest rates for this year. According to Bank of America, interest rate reductions by the Federal Reserve are expected to start in June. The U.S. will enter a recession in the first half of the year, according to Deutsche Bank, and the Federal Reserve will lower interest rates before July. The Federal Reserve is expected by Invesco to lower interest rates in June. According to JP Morgan, the Federal Reserve will begin reducing interest rates in either September or July. According to Nuveen, the cuts are expected to start in June or July, in the middle of the year. According to Truist, it will also occur in the middle of the year. It appears that the major financial institutions are projecting that the market will begin to reduce interest rates later than anticipated. My belief is that interest rates won't be lowered at the January meeting. March also seems premature given that there are just 2 meetings left and there isn't a Federal Reserve meeting in February. There are 2 things you should remember. Easier monetary policy tends to increase financial assets such as stock markets and property values. Historically, the lag effect has caused stocks to decline in the near term when the Federal Reserve begins reducing interest rates. However, the market for financial assets may see a wild ride once they begin to reduce rates and introduce quantitative easing. When central banks lower interest rates and implement quantitative easing measures, the financial asset market can experience turbulence. These actions inject liquidity, prompting investors to seek higher-yielding assets like stocks, real estate, and commodities. Stock markets may witness rapid fluctuations as optimism turns to pessimism. Real estate can boom, but may face a bust if unsustainable. Commodity prices can swing, influenced by currency values. Currency markets can experience turbulence due to rate differentials. Overall, central bank policy changes create an environment of risk and uncertainty, impacting investment decisions and requiring vigilance in navigating the financial landscape. All of that for now. I appreciate your support and ask that you please subscribe. Take care of yourself and have a great day.